am Professor Anuradha Jain, Professor of Economics from Vivekananda Institute of Professional Studies. So, today we will be discussing about circular flow of income in this series of Introduction to Macroeconomics. The circular flow of income shows the connection or linkages between different sectors of the economy. It can be explained with the help of economic models, and the circular flow of model is a picture of market economy in action. So, it tells how the money flows in the economy from one sector to the other sector. Whenever national output is produced, it generates equivalent amount of claims of that output in the form of national income. So, the process of simultaneous determination of national output and national income can be depicted through a diagram illustrating the circular flow of income and expenditure. And in the words of Lipsey and Crystal, domestic production creates an income which claims on the value of that production, and when all the claims are added up, they must be equal to the value of all the production. So, in each round of circular flow combines production, distribution and expenditure processes. So, every round appears to be complete. However, one round succeeds other in an unending process. Over a period of time, with the growth of production, population and higher level of production, distribution, expenditure, each successive round of circular flow may become larger. In a free market economy, the processes of production, consumption and exchange generate real and money flows through economic transaction of sale and purchase of goods or services. In a monetized economy, because nowadays all transactions are through cash and there is no barter system that exists, the flow of goods and factor services result in expenditure flow and income flow, and both expenditure and income flow continuously in a circular manner in opposite direction. The magnitude of these flows determine the size of national income and vice versa. To show the flows of expenditure and income, the economy is divided into four sectors, that is household sector, business sector, government sector and foreign sector. Now, why do we study the circular flow of model? Because it gives the clear picture of the market economy. It helps in the calculation of national income, which is very important for any economy to know about their national income. Formulation of trade policies, which promotes the exports and reduces the imports, because to control balance of payment problem or deficit, this formulation of trade policy becomes very important. It explains the importance of monetary policy by establishing equilibrium between savings and investment. In order to make our analysis simple and to explain the central issues involved, we take many assumptions. In the first place, we assume that neither the households save from their income and nor the firm saves from their profits. That means, whatever is earned is consumed, or that money should come into the circulation. We further assume that the government does not play any important part in the national economy when we are talking about the two sector model. In other words, the government does not receive any money from the people or by the way of taxes, and nor does the government spend any money on the goods and services produced by the firm or on other resources and services supplied by the household. Third assumption is that we assume that the economy neither imports goods and services nor exports anything. And remember that we are talking about two sector model. In other words, in our above analysis, we have not taken into account the role of foreign trade. And in fact, we have explained about the flow of money that occurs in the functioning of a closed economy with no savings and no role of the government. So, we can say that there are three models: two sector model, three sector model and four sector model of circular flow of money in the economy. Now, if we go in the detailing part of two sector model with the assumptions that we have discussed, it consists of two sectors, that is household sector and the industrial sector. Household sector demands goods and services and they provide labor resources to the business sector, and in return household sector make payment for the goods and services that they purchase and they receive wages for against the labor services that they provide to the business houses. Another is the industrial sector or the corporate sector, which produce and supply goods and services to the household sector, and businesses demand resources for production like land, labor, capital and entrepreneur. Now, in the diagram you can see that there are two sectors, household sector and the corporate sector, and from corporate sectors factor incomes moves from corporate sector to the household sector, that you can see the arrow in terms of money because all the transactions are cash transactions that we have assumed that it's a monetized economy. So, therefore, there is movement of factor income from business house to household and against the services, factor services that is provided by household sector to the corporate sector. And when corporate sector they produce goods, then goods are purchased by the household, and when they purchase goods they have to make payments and that comes from household to the firms. So, you can say that factor incomes are like wages, salaries, interest, profit or rent, and factor services labor, capital, entrepreneur or the land services, land that household may offer to the industrial sector. So, this is how the money move from one sector to the other sector, and therefore, this is known as the two sector model. Now, in a monetized economy, as we have discussed, that there is no barter system and money is involved everywhere. So, all these payments are made in cash. The landowners get rent, the workers are paid wages, the capitalists receive interest and the entrepreneurs earn profit. So, the money receipts of various factors are actually their incomes, and as the amount of money received by firm from the sale of goods or to the households is paid out of wages, rent, interest, profits, and that firm retain or profit nothing as undistributed profit. So, thus payments made to the factors of production will be equal to the value of current output. In other words, total money receipts of the firm will be the same as total income of the household. Now, in the final analysis, factor payments are equal to the value of output, which is equal to the factor income or household income. Now, further we can say that gross national income will be equal to the total disposable income of the consumers. Now, if we discuss about the three sector model, then this is also known as closed economy model, because we are not involving foreign sector here and we are assuming that no connection with the outside world and the economy is a self-sustained economy and there are no exports and imports involved. And this three sector model includes like household sector, industrial sector and the government sector, because we are adding here the government sector, and government play a very important role in the mixed economy like India. Okay, they collect taxes to provide resources and services to the public. Now, taxes if we take, then they are the withdrawals from the circular flow as they reduces the personal disposable income and hence consumption expenditure as well as the saving, because when any individual pays tax, it means that their disposable income goes down, and if disposable income goes down, then the demand for their products also goes down, and government expenditure is known as the injection in the economy, injection of the money in the economy, because when government spends money, that gives income to the public or the purchasing power of the people increases, and in return the demand increases. So, this government expenditure induces demand in the form of purchases of factor services from the household and goods from the business firm. Further, there is transfer payments made by the government like old age pensions, unemployment allowances, etc., which are also the injections to the circular flow, and this adds to the household income, creating household demand for the consumer goods. And this is the diagram for the flow of money from one sector to the other sector, and here you can see that there are three sectors: household sector, industrial sector, and the government sector in the center. Then there is factor market and product market, because factor market where factors of productions are taken, their services are taken, and in return the factor payments are made to these factors of production. As we have discussed in the two sector model, there are four factors of production: land, labor, capital, and entrepreneur, and in return they are paid like salaries, wages, rent, dividends, and rent against this factor services. So, this household, similarly as we have discussed in the two sector model, household sector provides the factor services to the industrial sector, industry gives them the factor payments. Similarly, household purchase goods produced by the industrial sector and make payments for the goods and services purchased from the industrial sector. Now, when government sector is there, then government also demand goods and services from the industry and they make payment to the industries. Secondly, they take factor services from the household just like the corporate sector, and in addition to this there are two components that we have discussed, that is taxes and subsidies. Corporate house, even the household, they pay taxes to the government as per the policy of the government, and government gives subsidies to the industrial sector for the promotion of the sectors. And government also make transfer payments to the household sector in terms of pension, old age pension or retirement pension or unemployment allowances, and there are different types of transfer payments which government make. And as I have already discussed that taxes are the withdrawals from the economy, from the circular flow. Transfer payment and subsidies are the part of the injections in the economy. Now, let us come to the four sector model, that is open economy, and when we are open for trade for the different sectors of the world, different countries of the world. And nowadays almost all countries maintain trade relation with one another, and the four sector model is formed by adding foreign sector to this three sector model which we have already discussed. The circular flow of income and expenditure in four sector model will be illustrated in the diagram which will come just right now, and each money flow has its counterpart. Goods flow in opposite direction. The lower part of this figure you will see that there are injections, there are leakages in the economy. So, in this diagram you can say that along with the other three sectors, that is household sector, government sector and the industrial house, we have added the foreign sector also, and foreign sector includes like transfer of money in the case of like imports, exports or government aids, foreign aid if we are getting, or in terms of FDI, in terms of any other loan and other way of transactions of money. Now, if we are importing goods from the other countries, that means the money will go out, our country will make payment to that country. So, that will be the type of withdrawals from our economy, because the money supply will go out, because we have to make payment for our imports. Similarly, when we are making exports to the other countries, then money will come in because they will make payments to our economy, and that will be the type of injections of money in the economy. Similarly, we can take loan, we can give loan to the other countries. If you are taking loan, then we will be paying interest, or we will be receiving interest against the loan made by our country. So, there are different ways how money flows from one country to the other country, along with other three sector factors that we have discussed here. So in short, we can say that when we include foreign sector also, then it becomes a four sector model. Okay, so it's a complete cycle of flow of money that is shown here in this diagram, and how money flows from one sector to the other sector, or how goods and services flows from one sector to the other sector. Now, the effect of foreign trade on the magnitude of overall circular flow depends upon the trade balance. Okay, like if imports of country exceeds its exports, that means if M is greater than X, M denotes here for imports and X is for exports, then the country has unfavorable balance of trade, because imports are more than exports. That means our payments are more than the receipts, because when we import we have to make payment, when we export goods we receive payments. So if imports are more than exports, it means that your payments are more than the receipts, and therefore it is unfavorable balance of trade, and because there will be leakages of income which is equal to the deficit amount, equal to the difference between the imports payment and export receipts. Okay. So if or on the other hand, if export exceeds imports, like if X is greater than M, then circular flow of income goes up the amount of surplus, because your balance of trade will be in surplus and there will be injection in the economy for the money supply. Money supply will increase more. Okay, so therefore it will be a surplus, and that will lead to increase in the national income with the multiplier effect. Now, because of this money inflow and money outflow, everything depends upon how much money supply is there in the economy. If money supply is more, then the demand will be more. If demand increases, okay, then production will be more. This production will lead to increase in the employment and income generation, and this is how multiplier effect will take place, and money income will multiply, our national income will multiply. Okay, so it depends like how much leakages are there, how much injection of the money is there in the circular flow of income. So the circular flow of income will remain at a constant level if savings, tax revenue and imports, which are the leakages, are equal to the investment, government spending and exports, constituting injection in the circular flow of income in the two. So, three sector or four sector economy, and symbolically you can say this equation as S plus T plus M is equal to I plus G plus X. Now, why savings are considered to be the withdrawals? Because when you save money, it means that you are not consuming that money is not coming in the circulation, because total income Y is equal to C plus S. If S increases, it means that your C is going down. Okay, so therefore savings are considered as withdrawals. Similarly, tax, because when government imposes tax, it is a compulsory payment, so therefore our disposable income goes down, and if disposable income goes down, it means that you can demand less of the commodities, you can buy less. Why? Because you are left with less income. Similarly, imports, when you import goods, you are making payment, and therefore that is also withdrawal, because money is going out from your economy and from your circulation. So these three S, T and M are considered to be the withdrawals from the economy. And similarly, investment, government expenditure and exports are known as the injections, because when you invest money, it means that money is added to the economy and money supply will increase in the economy, the circulation will increase. Okay, government expenditure also, because when government spend money, that means people will get income, people will get employment. Like suppose for example, if government is increasing the infrastructure facilities, if government wants to improve infrastructure, build better infrastructure, that means they will recruit people, okay, and people will get employment, they will get income, and that income or in terms of subsidies, or in terms of transfer payment, or in terms of this type of employment generation will induce money in the economy. So government expenditure is also the injections that will increase the money supply in the economy. Similarly, exports, as we have discussed, that when exports increases, then also the payments are received, you will receive money against the selling or against your exports. So that is also to be the part of injections in the economy. Now it is not necessary that leakages and injections in various sectors of the economy should be equal to each other at the sectoral level. Now if the overall leakages from the circular flow are less than the injections, then expansionary forces start operating in the economy, raising the level of income in the economy. Why? Because what happens is, like if leakages are more and injections are less, that means the money supply has gone down, and that creates imbalance in the economy, and therefore expansionary forces are required to bring the economy in balance. Otherwise that will lead to many other problems like inflation and all, because maybe the demand and supply mismatch will be there in the economy. Okay, so therefore government policy also has to take steps accordingly, and this process comes to an end when leakages once again equal to the injections, leakages or maybe maybe the injections in the economy. Now similarly, if leakages exceeds injections in the circular flow, contractionary policy begins and income level declines, because if leakages are more than injections, that means that the money supply is going down. So that means the contractionary process starts and income also goes down, because income, national income depends upon the number of times the money changes hands. It depends upon the demand in the economy, and demand depends upon the income level of the people. And if there are more leakages, it means that income tendency is that income will go down, and it reduces the savings also, because Y is equal to C plus S, and if C is going down, ultimately that will impact Y, and if Y is less, then obviously the next step will be that your consumption will also go down and your income will also go down, and tax collections and imports, okay, that will also be affected. So this process continues till leakages again become equal to the injections in the economy. Okay, so this concept of circular flow of income is very, very important, and it play a very, very important role in understanding the national income concept of the economy. Okay, because understanding of this will also help in preparing the government policy or monetary policy. Okay, because whether they should go for expansionary policy or they should go for contractionary policy depends upon the level of circular flow, whether there are injections in the economy required or whether withdrawals are required in the economy. Okay, and recently also you can see that at the time that we are facing now, this time also government policies are changing. Monetary policy, RBI is taking different steps. They are going for expansionary policy because they want to create, they want to generate more and more employment opportunities, more income opportunities. Okay, so that people will get income, they will demand, because that people lost their jobs, there are no incomes, and everybody is affected because of COVID, because their business are affected, and ultimately it may have long run impact. National income may go down further if the corrective measures are not taken by government or by the Reserve Bank of India. So therefore, understanding of this circular flow of income is very, very important for any individual as well as the government officials and the general population of the economy. Okay, so thank you so much, and we will continue with more topics in our more sessions that I will be taking with you. So thank you so much. Thank you.